internal audit at National Bank at National Bank. I think at National Bank needs no introduction. All of you know at National Bank. So he is the person in charge of internal controls of the bank. So Dr. Niroshana Senviratne is also a member of the Institute of Chartered Accountants of Sri Lanka as well as attorney at law, and he has extensive experience in this area, not only in Sri Lanka, even in overseas. So he will be bringing a wealth of experience into the classroom. So please discuss, ask questions, actively participate in this session, because you can gain a lot, because they have hands-on experience on corporate governance related aspects. So without taking much time, so let me invite Dr. Niroshana Senivaratne to continue the sessions. So Niroshana, this session will be on Zoom, but here are subsequent sessions will be classroom based sessions. Because of this long holiday, they have decided to have Zoom based session. So I welcome you to the session and invite you to conduct the discussion.
Right.
Right.
Thank you very much, Samanthi, and sorry to bother you. You're away from us. I don't know the time also. So thank you so much. I will continue from here, Samanthi. Thank you very much for the invitation, uh, and all the very best in your future activities. Good
Thank you.
afternoon to all of you students. Um, so as Professor Samanthi rightly said, I have been in this industry for, in the banking sector alone, I have been continuing for about 33 years now, out of which about 20, roughly about 20 years, I have been heading internal audit function in various banks, starting from Nations Trust Bank, then ABN AMRO Bank, NDB Bank, then Middle East Commercial Bank of Qatar, heading audit, and now with HNB, heading internal audit for the last 7 years. So we are directly reporting to, as corporate governance suggests, directly reporting to the board audit committee, and uh, we are hands-on. So please feel free to ask questions. Then only I also can get into real mode. Otherwise, it's I'm just looking at a computer and talking. Disturb anytime, ask questions, then we can make it a more fruitful session. So we'll start with corporate governance. You all have covered corporate governance, I think, theoretically enough. So I will just run through some of these areas so that I will refresh your mind into what we are going to talk today. Is that all right?
Yes. Oh.
Right, good. So let's move time to time, speak. So we are in the same page. Otherwise, I'll be just delivering it. Right. So corporate governance. Can anyone tell me what corporate governance is? At-
The way in which the organizations are directed and controlled, the system basically.
Okay, right. So in the organization structure, there are shareholders. Right now, if I take HNB structure, Hatton National Bank has been formed about 130 years ago, and we have a shareholder structure. We have about 19,000 shareholders. So all these 19,000 shareholders are not able to manage the bank. So they have appointed about 13 directors. So directors are also very busy. They are shareholders, some are not non-shareholders. So they have appointed a managing director. Managing director, again, alone cannot manage. So he has identified deputy general managers. We have about 10 deputy general managers who are heading different verticals. And under them, there are assistant general managers. Then below that, chief managers, senior managers, executives, assistant managers, so on and so forth. The pyramid structure continues. So when you said corporate governance is managing the business, whom was it addressed at? Is it governing the deputy general managers, AGMs, directors, shareholders? Who are the people that is being addressed by the corporate governance in this pyramid structure? Is it the managing director, then the management, deputy general managers down the line, directors, shareholders? Who are the corporate governance is trying?
Board of directors and the
Uh-huh.
and the management, basically.
And the management. What about shareholders?
Shareholders, the focus, of course, the main focus is to protect shareholders. So it is the corporate governance, basically it ensures transparency and protection of shareholders and the other stakeholders, and it through a proper system of managing the company business process.
Yeah. So that's basically aiming at the directors and expecting them to manage it properly so that the shareholders and the stakeholders are protected. Is it right?
Yes.
Mostly directed at directors. So let's see. We are somewhere there actually. We are. I mean, 80 to 90% we are there. Just see what we really try to understand here. Now, corporate governance, actually speaking, is a real complex affair. Why it is? It talks about people. Now, the same question that I raised now, there are multiple uh, sections of people in a company. As we rightly said, shareholders are there, directors are there, then the management, corporate management is there, then the normal other management is there, then there are employees, suppliers, all the stakeholders, uh, independent observers, statutory authorities like central bank, SEC, CSE, and all that. So there are multiple people relying on these organizations functioning. Now, we as HNB, we go as a systemically important banks. Roughly about how many banks in the country? Commercial banks, how many banks?
13.
Huh?
13.
I couldn't hear. Can you repeat?
13.
No, still I didn't get. Is it 10, 20, 30? 5? How many commercial banks? Yeah, it's 24. 24 commercial banks are there. Out of that, there are 6 banks that the central bank has named or recognized as systemically important banks. When you say systemically important banks, that means if something happens to those 6 organizations, any of them, there will be a huge impact on the economy. So can someone name those 6 commercial banks? These are called SBIs, SIBs, systemically important banks.
Commercial Bank, Sampath
Right.
Bank,
Right.
Bank of Ceylon, People's Bank,
Right.
a National Savings Bank, and HNB.
Correct. Excellent. Very good answer. So when you are recognized as a systemically important bank, there are competing banks have their own regulations. At the same time, those 6 banks have further tightened regulations that we need to strictly follow at all times, right? So their visits, central bank is coming and visiting and auditing those 6 banks frequently than the other banks. So therefore, multiple requirements are there on the corporate governance side, in addition to the ones that all other banks are following. So people factor, yes, there are multiple groups of people interested in the company. Now central bank is one of them, uh, government is one of them, right? Like that. So corporate governance is aiming at managing people, or rather controlling them in different ways. And different groups of people have different purposes. That's the next box, right? So different people have different purposes and their objectives, given objectives. So those need to manage. So to manage those, there are processes, right? Uh, Once you go through that, then the performance measurement, whether they were able to deliver what they were asked to deliver uh, at the end of the year. So if you take one category of people, shareholders' purpose has to be identified. Then to reach that purpose, there has to be a process. And at the end of the day, end of the year, whether the performance uh, or other objectives are achieved by the shareholders, right? Same way, directors, one group of people, directors, what is their purpose? What are their objectives? What is the process, the policies and processes? Then, based on that, at the end of the year, they need to be assessed against their objectives. So that's the challenge in corporate governance, right? So this explains that. So we call it 4P approach, where people exist on every side of the business equation. They are the founders, the board, the stakeholders, consumers, uh, impartial observers, right? So for corporate governance, for learning purposes, we have to pick and choose shareholders and directors. And it goes beyond that. But for learning purposes, we will be picking shareholders and the directors. Then the purpose. Every piece of governance exists for a purpose, right? So all these rules, expectations are for a purpose, to achieve something. Purpose vary from person to person, that is people factor. There lies the fundamental problem. Whose purpose? Is it shareholders' purpose or directors' purpose? Right? Then the processes and the performance. So, in a nutshell, corporate governance is about agency relationship. You all have learned about agency, principal agent relationship, right? That is where we are leading in corporate governance, right? So uh, you can have a company, right? We can call it a parent company. Parent company will have a subsidiary. For learning purposes, we'll say 100% owned subsidiary. Then that subsidiary will have directors. So shareholders of, there are shareholders of the parent company, there are shareholders of subsidiary company, right? So it's a parallel horizontal relationship with those are principals. Shareholders are principals, directors are agents. So here in this side, left hand side, if you take the subsidiary has shareholders. At the same time, the shareholders have appointed directors. Right? Now see, these directors are the agent of the shareholders. Okay? So I will ask you a question. Now, these directors, should they work towards the subsidiary or the parent company? Are you clear? Are you clear my question? There is a subsidiary. Subsidiary has appointed shareholder directors. At the same time, the subsidiary is fully held by a parent company. So there are shareholders of parent company also. So what I'm asking is, the directors here, are they responsible for the shareholders of the subsidiary or to the shareholders of the parent company?
Shareholders of the subsidiary.
Shareholders of the subsidiary. Any other answer? Any other answer?
Holders of parent as well as the subsidiary.
You can't have two principals. Right? In your organization also, you can't have two bosses, right? If you have two bosses, what will happen? Right? These are basic internal controls, right? So your span of control, you can't be reporting to two bosses, because when Mr. A comes and tells me to do something, I will say I'm busy with Mr. B's work. When Mr. B comes and tells me something, I will say I'm busy with Mr. A's work. Right. So I need one answer.
Sir,
Someone
because
gives the-
they are fully owned by parent company, I think it is parent company.
Right. The answer is what you said now. Right. Those directors are responsible to take care of the interest of the parent company shareholders. Right. So that is why I tend to agree with the previous answer as well. Right. But this is why I'm saying corporate governance is little complex than we think. Right. So answer to that question, the directors of subsidiary is responsible for the directors, shareholders of the parent company. Whether it is 100% owned or not, that is how the logic goes on. Right? So we will try to understand why it is as we go. Okay? So agency principles, so the reason the horizontal and vertical separation is principal and agent, right? The red part below, right? Principal is on the left hand side, the agent is on the right. So principal, who are the principal? Principals are the shareholders, right? Shareholders are interested in ROIs, longer term profits, sustainability of their company, right? So their objectives differ from agents' objective. Who are the agents? Agents are the directors. Their objectives are slightly different. They want business growth, quick acquisitions, quick profits, right? So they may continue for 1 year, 2 years. They want to make good profits at the expense of resources and exit the organization. So therefore, shareholders' objectives and directors' objectives always clash. Okay, So all these corporate collapses, whether it is Enron, WorldCom, Polypec, BCCI, all these companies, right? Some of them were Fortune 500 companies just before they collapsed, right? All these companies, if you really analyze, the directors were only interested in acquisitions. WorldCom, that is how they strategize. That is how they became big. Acquisitions, quick profits, hiding losses. All those were done by directors without the knowledge of the shareholders. Shareholders' objectives were longer term investment, longer term growth, sustainability. Those were their this thing. So this is what happened. Agents' objectives differed from the principal's objective. Is it clear?
Yes, sir. Clear.
Clear. Okay, right. So we will try to understand agency a little bit, right? Legal side of it, right? So how can an agency be created in legal sense? You'll have done law some part of your life. How can an agency get created?
By the agreement.
By agreement, yes. What else? How else? How else?
By the agreement between directors and the shareholders.
Yeah, so I'm not referring to company as such now. In general, I'm asking, in law, how do an agency being created? One way of creating is by agreement. Principal and agent agrees, and principal says, okay, you work for me. I will give you the instructions. You do whatever I'm expecting you to do. Right? All these agents, that is how it works, through agreement. Agency can be created through
Verbally.
verbally also, yeah, by agreement, right? It could be implied or expressed, right? Implied is understood that so and so has appointed me to do that. Number two, by ratification, right? By ratification in the sense, I am the agent of a company. I think that he expected me to act in that way, right? Then I acted. He knew. My principal knew that I was acting like that. He kept quiet. Okay? He kept quiet. And when the transaction is done, I go back to him and say, I was expecting you to give instructions. You have not given me instructions. Can you ratify it? Yes, he can ratify. So the agency is created. Is it clear? Then by estoppel. Estoppel is, again, same story. I thought I have been appointed by my principal as his agent, right? I was dealing with a transaction. He was well aware of it. Then I did the transaction. When I went back to him, he says, no, I never instructed you to do that. He can't do that. If he knew that I was acting for him by estoppel, he is not allowed to get exit from the transactions. He will be responsible as a principal. Now, as an agent, whatever the conditions that I put, right, these are principal's conditions. The contract is binding between the buyer and the principal, not with the agent. I'm doing just a agency job, right? Same principle applies for directors. Director is agent, right? Directors will do transactions. The company is binding. That is why all these controls are coming for directors. Then agency can be created by necessity also, right? You all may have heard this case. Great Northern Railway versus Swafield. The horse transportation. Have you all heard of? Are you all aware of that?
Yes, sir. But
Yes.
some may not.
Some may know. Okay, right. So I
But
will
if you can
explain.
explain, that's good, sir.
Right. So earlier case. Now, first one, number A, is by agreement that all of us understand. Number 2, that is B, by ratification. Kellner versus Baxter, 1886 case. That was a famous case, very old case. There was a person, there was a company to be formed. So that person was promoting. He was the promoter before the company was formed. Company was the principal, right? The promoter went and organized everything. They organized a party, and I think he bought wine or something. Wine, yes. So he bought wine on behalf of the company, right? And the function was over. Company was not formed, and he wanted the suppliers sued Kellner for the wine. He was the promoter. He was the promoter. He organized a what do you call the ceremony. He ordered wine on behalf of the company, right? And the function went through, but the company did not exist, right? So all the suppliers, they came behind Kellner and asked him to pay for the wines that he purchased. So he said, no, it is not for me. It is for the company I bought. So company has to pay you. At that time, company was non-existent. So as a result, ratification was not given because it was a principle that was not existent at the time of the transaction. Is it clear? Is it clear?
Which means if that is not legally formed, which means it is not existence. Is that?
Exactly. Company was not legally formed, right? And before that, somebody got appointed as the promoter. So that promoter was buying left and right for the function. He did not pay. He was contracting on behalf of the company. Company was not inexistent at that time. So therefore, damages were not paid by the company. Kellner had to pay the damages. So for a transaction to be ratified by the principal has to be inexistent. If there is no principal, how can I be an agent? That was the logic. Is it clear?
Yes, sir.
Right. Then the estoppel. Estoppel means you do a transaction, right? Say, for example, I appoint you as my agent and say, okay, you sell this land for me. So you will be buying, looking for buyers, and you found a buyer, right? And you execute the transaction and you sold the land. Okay. So whose land is that? That is my land. Who sold it? You sold it. Okay. So the buyer will come and ask for the deeds and all that from me. Then I cannot deny that I have appointed a sales agent to do this transaction. I cannot say that there was no transaction. Who is so and so? I have never appointed him. All that. I need to act on the basis that I have known that Mr. So and so was acting on behalf of me. So that is estoppel. That the law will prevent me from exiting the equation. Is it clear?
Yes, sir, for me it is clear.
Right. Then by necessity. So Great Northern Railway versus Swaffield. So this is again very old case, very famous landmark case, 1874. This plaintiff or the Swaffield, he sent horses in the train those days, right? For somebody to uh, unload the horses and take it from there. Okay, so that may have taken maybe 2 or 3 days on the railway track. However, at the station that the horses were supposed to be embarked, taken out, nobody came to pick the horses. Okay, so railway company had to feed the horses maybe for few days out of necessity. Right. Then later, somebody came and took the horses. So this railway company was claiming damages or the feeding costs of the horses from the owner. Right. So that is by law. It says by law, by necessity, agency is being created. So railway company became the agent of the principal who sent the horses through the channel. Is it clear? So agency could be created through necessity, that is a horses case. It could be through estoppel, where they can't deny that they had a transaction like that. By ratification, principal can ratify later that yes, so and so I instructed so and so to act on my behalf. So later, or upfront, you can have an agreement or implied terms and conditions. Is it clear?
Yes, sir.
Right. So that is agency. Right. So what we really have is the agency relationship between the shareholders and the directors. Right. So there are corporate governance talks about shareholders as the principal, directors as the agents. So these are the main two categories in the people quadrant of that four boxes identified. Then whose purpose? Shareholders' purpose, and also certain guidelines are for directors' purpose. Certain processes are there for directors, certain processes are there for shareholders. Certain performance indicators are there for shareholders at the same time for directors. So that is how the entire corporate governance system works as per the rules now. Right. So you all learned about all these corporate collapses, right? So WorldCom, Enron, Conseco, Texaco, Financial Corp of America, all these companies failed, right? WorldCom, the bankruptcy filings were done for 100 billion US dollars, right? Enron about 63 billion. All these happened in 2000 2002, 2001, right? And prior to that also. So this is where, when they studied, they realized what went wrong in those companies. What went wrong in WorldCom? Can someone tell me? What were they doing? What kind of business they were in? Anyone? WorldCom? No idea? You all had few sessions, right? Corporate governance. This is the 5th session. No? Welcome. What business they were in?
Telecommunication.
Telecommunication. Enron? No idea. Right. So welcome. So Welcome was the United States' second largest long distance telecommunication company, right? Okay. Welcome grew largely by acquiring and telecommunication companies. Acquiring. So whose strategies are there? Who are interested in acquiring companies? Directors or shareholders?
Directors.
Directors, because they need to grow and they want to become the directors of the largest company in the world, kind of attitude, right? So they kept on acquiring companies. Most notably, MCI Communications was one of the largest companies they acquired. Company used fraudulent accounting methods to disguise or hide its decreasing earnings to maintain the price of WorldCom stock. They were guided by the stock market prices, right? So when you acquire, you are short of capital, you are short of working capital, right? So that company, the subsidiary, were making losses. So they were hiding those losses in their accounting records. So directors manipulate records. Shareholders were unaware of those transactions. The fraud was accomplished by primarily in two ways. Booking line cost, right? That is interconnection expenses with other telecommunication companies as capital expenditure. The revenue expenditure were capitalized, right? So without writing off to P&L, those were capitalized, right? Accounting error. Who should detect it? Your
By
revenue
the
expense.
Auditors.
Yes, auditors, right? So you need to have checks and balances in your company. You have the level 1, L1 controls, L2 controls, and L3 controls. Level 1 controls at the accounts department. Level 2 controls the risk and internal audit, right? Level 3 controls the external auditors who come there and certify the financials. So all these guys were not able to pick it. They were defunct. They were not able to identify the massive error, accounting error that they did purposely. Inflating revenues with bogus accounting entries. So they were passing just journal entries and inflating accounts. In 2002, a small team of internal auditors at WorldCom worked together, often in nights, to investigate and reveal $3.8 billion fraud. So this is the time, that is 2002, the company collapsed. Arthur Andersen withdrew its audit opinion for 2001. Previous year, they have given a clean opinion without checking anything, right? This error was continued, or rather, purposeful suppression was continued. That was not detected by Arthur Andersen as the auditor. So when we were articled, we were always talked about big five, right? Now only big four. Arthur Andersen exited the equation. Enron. What happened to Enron? Enron Corporation employed approximately 20,000 staff, huge company, Fortune 500 company, and Fortune 500 best innovative company also, right? In year 2000, right? Massive company. At the end of 2001, it was revealed that its reported financial condition was sustained substantially by an institutionalizing, systematic, and creative known. So they were also dealing with accounting fraud. They were hiding losses, right? In Enron's case, the company would build an asset such as a power plant and immediately claim the projected profits, not actual profits, projected profits. The prudence concept. What does prudence says? All of you are accountants, right? Prudence. What can you recognize?
Revenue should not be overstated.
Yes. Loss.
Loss should be like whatever the provisions, everything should be stated.
Yeah. Loss should be taken then and there. Profit should be only realized profits. Prudence. So the scandal also brought into question the accounting practices and activities of many corporations in the United States, was a factor in the creation of Sarbanes-Oxley Act. So there were two lawyers they appointed, Sarbanes and Oxley. Those were the very famous lawyers in US. They were appointed to study what went wrong in this previous year Fortune company, Fortune 500 company. Previous year they were the best, right? They won awards after awards, right? How come they collapsed the next year, right? There again, Arthur Andersen was found to be negligent. That is the exit of Arthur Andersen from the Enron case. So Sarbanes-Oxley Act came into place after their studying. In the US, it's an act. So you have no way of exiting it. It's a regulation. It's a statute. It's an act. So they need to, all the companies since then need to abide by all those rules that were put in the act.
So are
That
you
is
moving to the slides?
Yeah, you can see.
We can't see. We can only see the first slide. So they are on.
I moved to another one. You can see.
No, sir, we can't. Even it is not in the presentation mode.
Not in the presentation. Wait.
Now okay, sir.
Huh?
Now it is in the 10th slide.
Okay.
Yeah.
So
Now
I'll
it is.
just. Okay. So I'll just. First slide is visible, right?
Yeah. Now.
So this is the second slide that I was talking of. Second one is also visible, right?
Yes, sir. Yes.
Right. So this is the people part. Then from here to, can you see my cursor?
Yes, sir. Now it's so.
Cursor also you can see, right? So the purpose part comes in, the process part and the performance part, right? So that is why I say this is a little bit complex affair, corporate governance, more than what we think. This is my third slide. Fourth slide is the shareholder subsidiary, parent company. Parent company shareholders are there. Those are the principals. Then we have a subsidiary company. Subsidiary company has appointed their directors. So the principal is there. At the same time, there is an agent, that's a director. So these directors are responsible for the parent company shareholders. That is why it is little complex. And this slide, what I meant, principals are the shareholders, agents are the directors. Shareholders have different objectives. Shareholders are interested in ROI, longer term profits, sustainability, right? Longer term sustainability of companies. Whereas the directors are interested in business growth, acquisitions, profits, right? Good pay. That is what they are interested in. So this is where this Enron and WorldCom, the reasons for their collapses. So directors were just going executing their objectives, right? So this is where the central bank or rather US government appointed Sabins and Oxley to study and see how we can control. So those guidelines came in for the directors. What are the things that they should do? What are the things that they should not do? All those came in as by way of a act, Sabins-Oxley Act. This is where the agency that I mentioned, agency can be created by agreement, by ratification, Kellner versus Baxter case, by estoppel, by necessity. Great Railway, Northern Railway case we discussed. Then this slide where I mentioned WorldCom and Enron, these are the bankruptcies filed for the values. Then this is about WorldCom story, what happened. This is the Enron story, what happened. Now I am moving into Barings Bank. Is it clear?
Yes, okay.
Right. Any question? No question. Right. So Barings Bank. You all know what happened to Barings Bank? Barings Bank was an English merchant bank, right, in London, and one of the world's oldest merchant banks. It was founded in 1762 and was owned by Barings family. Huge bank. Okay, the bank collapsed in 1995 after suffering losses, right, of millions based on speculative investments in futures. You all have done futures. I will explain a little bit of how it works because this will be useful for your internal controls also. In banks, we have this practice. All the banks, all 24 banks, they have their treasuries, right? Treasury is the main function of the bank, kind of a heart where they will be investing monies based on the market conditions, right? They are the people who will be giving rates and all that. So there is a practice that we always maintain. Treasury front office and treasury back office has to be two separate verticals. There are people in the treasury front office. They will be dealing with other banks, other organizations, other financial institutions. All these entries are posted by the back office. So generally, the recommended practice is the treasury back office will be reporting to CFO, finance. Treasury front office will be reporting to business or the managing director. So business and the operation has to be segregated. So that's a practice. That is practice one. Practice two is squaring of transactions. Right? Squaring off means, say, today's dollar rate is 320, for example, right? So there is a importer who will be coming and asking us, my shipment will come in 3 months time, December. So when this shipment arrives, I have to pay in dollars. So what would be the rate in 3 months time? So we can't predict. We do not know whether it will be 400 rupees per dollar or it could be 180 rupees per dollar. Okay. So therefore, we will offer that importer a forward exchange. So the treasurer will have his old graphs and all those things. He will use those and he will say, okay, in 3 months time you come here, I will sell you dollars for you to pay your exporter. I will pay you dollars I will sell at 325. Today's rate is 320. Are you all with me?
Yes, sir.
Yes, sir. Yeah.
Right.
Yes, sir.
So that's my agreement with him. So definitely he is going to come in 3 months' time and ask, sir, give me my dollars. Market rate is 340. You promised me 325. Give me at 325. Okay. So we have to buy dollars at 340 in 3 months' time and give this customer, because we promised gentleman's agreement, I have to sell it to him at 325 at a loss of 15 rupees per dollar. You understood? Is it clear?
Yes, sir.
Want me to repeat again? No?
So it's clear, sir.
It's clear, right? So what if the rate comes down? So I agreed to sell dollars at 325 to him in 3 months' time. By December, if the rate is 280 rupees, wow, great. So I can buy from the market at 280 rupees and sell to this importer at 325 rupees. Massive profit. Okay. So this is exactly what Nick Leeson did in Barings Bank. However, it was with futures, but it was something like that. So he agreed to sell at 325 and he was holding on to that transaction without doing anything, right? He was speculating. He was expecting the market to come down. So therefore, he can buy from the market at 280 rupees and sell to him at 325 and make a massive profit. So that was his expectation, but it did not happen that way, right? There was this earthquake that happened in Japan. So these were Japanese futures. So the market crashed. So as a result, he was not able to get that loss absorbed. The entire loss wiped off the bank. So there is a standard rule where it says you need to square your transactions. So squaring of transactions means, so I agreed with that importer to sell these dollars at 325. At the same time, immediately what I have to do is I have to agree with another financial institution to buy dollars at 323. So my margin is 2 rupees. So in 3 months' time, I will go to that man, that financial institution, and buy those dollars at 323 and sell to this importer at 325. So my margin will be 2 rupees. That is called squaring off, right? Hedging your transactions, right? So Nick Leeson purposely did not hedge his transaction because he was a risk taker. He was very sure that the prices will go down. As a result, he should be able to make massive profits. Okay, so there again, agency principle applies here. He was the agent of the company, right? And the principals, the senior management, upper management, board of directors, everybody knew that Nick Leeson from Singapore office, he was bringing massive profits, right? He was the main man. So he was bringing massive profits into the company. So they kept quiet, right? So Nick Leeson had his own game. He was the flow leader, he was the front office manager, he was the back office manager as well. So he was doing everything. All the controls were lapsed. As a result, he was able to wipe off one of the banks. Is it clear? So he was jailed. Nick Leeson was jailed. Now he's out of the jail. He wrote a book, right? You can Google it. How to Rob a Bank. Okay. So bestseller book. Okay. How to crash a bank or how to rob a bank. I can't remember. Okay. So our economy also went through similar channel, right? One of our economic gurus also wrote a book. Right. So that's about Barings Bank. Any question on this? So he was basically hiding all these transactions, all his losses in 58 account, 8888. The account number was 8888, 58 account. He was hiding all, that was a suspense account where he hid all his losses in that 58 account. Right? Any question? No question? Right. So when these companies, Polypec, BCCI, now there was a big bank crashed during the same time. That was BCCI Bank. They had a branch in Sri Lanka also, BCCI Bank, right? So that bank also, that branch also closed down in 1990s and went back to their own country, and bank collapsed. BCCI, Polypec, Barings Bank, all those banks collapsed, companies collapsed. And as a result, time to time, different groups were appointed under the chairmanship of Cadbury, Greenberry, Campbell, Higgs, Turnbull, Smith. Multiple reports were issued. Multiple committees were appointed for them to study and get back with recommendations. Right? So this is what you learned all this time. So I'll skip this slide. Right. So in a sequence, in 1992, a Cadbury report produced by a committee chaired by Sir Adrian Cadbury. So he studied and he gave, that was after Polypec collapse, he was appointed. He gave series of recommendations. Those were captured in the combined code and the listing rules. Then in 1996, Greenberry committee was appointed. Again, they published codes, including the recommendations given by Cadbury. Then in 1998, Hempel committee was appointed. They also gave recommendation and also combined Cadbury, Greenberry, and Hempel all into it. So in 1999, interestingly, a separate committee was appointed. That's a Turnbull committee. Turnbull committee was to, main target was to identify internal controls and give internal control recommendations for companies to follow. So Turnbull report is very interesting. Gave multiple internal control regulations. That's a Turnbull report. Then 2003, Smith report recommended audit committees, right? So these are the main two reports that will be tested. Turnbull report on internal controls and Smith report on audit committee recommendations. So those are the audit committee recommendations that got captured into combined code, and also our code. Almost all the recommendations given by Smith report is being captured into managing audit committees. Then Higgs report, how to manage executive directors, non-executive directors, all those guidelines were given. So in a nutshell, all those have been included into our code, Sri Lankan code, and also stock exchange regulations. So this one is important. This captures how things moved in UK, because we are aligned to UK process, because Sarbanes-Oxley is being used in US, that is law, and it's an act of parliament applicable in US. UK, it is combined code. We need to comply or explain, right? We need to comply. If we are unable to comply, we need to explain why we were not able to comply, right? So therefore, we are more aligned to, Sri Lanka is more aligned to UK Code of Governance. So 1992, Cadbury Committee, 1994, Greenberry Committee, 98, Hampel Committee, 1999, Turnbull Committee, that is on internal controls. Smith Report is independent directors, right? Independence of auditors. And Hicks Report, non-executive directors. No questions? Then shall I ask questions? Are you all with me?
Yes, sir.
Yes, sir. we are.
With me, but no questions. Eh? Right. We'll take a break in another 10 minutes. Okay. Right. The listing rules of London Stock Exchange, right, is based on comply or explain. We need to comply. Now, all the corporate governance report that you see in our annual reports, HNB annual report, any company annual report, you will see comply. Yes, we are complying. You tick, say complied, complied, complied. But this one, we were not able to comply because of these reasons, right? So get hold of annual reports, right? There is a separate chapter for the corporate governance report. Go through it and see how it is structured. Okay. So broadly, corporate governance rules, okay, talks about accountability. Okay. Number 2, responsibility. Number 3, equitable treatment. Number 4, transparency. Vision to create long-term value, and finally ethics. So corporate governance rules aim at those. Accountability means responsibility for one's own decisions and actions. So directors, if they make decisions, if they take action, they will be responsible and accountable. Directors' liability is collective and also individual. They need to be individually liable and also collectively liable. So that is accountability. Directors' responsibility, right? They are responsible for efficient performance of duties, right? They can't just drag decisions. They need to be responsible to execute these effectively. Equitable treatment, for an equitable treatment of all stakeholders. They can't say minority shareholders, no, we are not taking care. These are the majority shareholders. They are the governing shareholders. No. They have to be treating them equally, right? Then the transparency. Whatever they do, they need to be transparent, right? If they they have interest in a transaction, they need to be transparent and tell that, okay, I am a related party. I have a responsibility. We'll try to understand from the Companies Act, right? Vision to create long-term value. You can't just go in acquisition or profit making. there has to be a long-term value creation in the organization. And they need to practice ethics at all times. Main ethics, objectivity, honesty, professional due care, confidentiality, okay? Integrity, honesty, professional due care, confidentiality, right? And objectivity. Objectivity, you can't be subjective. That is why it says equitable treatment. You have to be objective with everybody. You can't be subjective to one category of people, right? So your professional ethics that you learned all this time as a professional uh, accountant. So those are the 5 main professional ethics that you need to do. Same thing applies to directors. As directors, they need to be all those uh, professional competencies should be there with them, right? Right. So in general, so how do we establish effectiveness, right? Appropriate balance of skills, experience, independence, all these need to be maintained. There should be formal, rigorous, and transparent procedure for the appointment of them in general, right? How can I get appointed as a director, right? There has to be a transparent way of picking and choosing Mr. A for the role. So once it is selected, that person need to live that capacity. If he's a professional lawyer, right, he has to be a professional lawyer, contribute in that sense. If he's a professional engineer, he need to contribute in that sense, right? So whoever, it could be a banker, he could be a chartered accountant who is on the board, they have been hired for their professional competency and professional qualifications. So they need to stand by their ethics and their standards, maintain those standards and contribute, right? That is why all the independent directors are well qualified independent directors, right? Any bank could hire well qualified independent directors into their boards, right? We have chartered accountants, we have engineers, we have several lawyers in the board, right? So they come with those backgrounds and contribute at the board meetings. So all these board members need to be
Is that a mandatory requirement or just
no, no, there's no good question. There's no mandatory requirement because mandatory requirement are independent directors, non-independent directors, those kind of balance need to be there. There again, they are not mentioning how many out of the 13, how many need to be independent directors, how many need to be executive directors. They are not mentioning that. That balance we can maintain. At the same time, we want the best people in the board. So therefore, our decisions that we make at the board level are well debated before the decision is made. Once the decision is made, we all have to rally around that decision, right? If there are 13 members, I was opposing to one of the decisions that the bank is going to make, not me. Out of the 13 directors, he may not like it. He may have a valid point also. But if it was overruled by majority of shareholders, majority of the directors, and they agreed on that. So that director cannot say that I told you this and that, this is not going to work, this and that. No, he has to pull the rope the same direction once that major decision is taken. So he is given an opportunity to justify his case, right? His professional advice is taken, right? In addition to that, if he wishes to, outside professional advice also can be taken, right? All that opportunity is given, but once the decision is made, we all have to pull the same line. right? So therefore, there's no requirement as to number of chartered accountants in the board, number of lawyers in the board, number of engineers. No requirement as such, right? So directors have to be re-elected every year, right? Time to time. And also rigorous annual evaluation has to be there. Now these are intact as a systematically important bank. We do it very, very religiously. We do it. We evaluate. Selection process is very strong. Transparency procedure in getting a director onto board. Sufficient time. They are being trained by us sometimes as vertical heads. We go and train them on different areas because we know our subject. So we go and educate them on corporate governance, internal auditing, external auditing. That I cover that part, internal controls and those stuff. Then the chief risk officer covers his area. Then the chief legal officer covers legal side, right? He may be an engineer, right? He's coming to contribute on the engineering side. So he need to know banking. He need to know how bank operates. He need to know about controls, right? Auditing practices. All that need to be knowledge. So they will be going through an induction program, mostly conducted by us. Sometimes there is an institute of directors, right? Like Institute of Chartered Accountants, Institute of Directors is there. So they conduct training programs for directors. So time to time they will be attending those programs where corporate governance is covered at a very, very extensive level, right? So induction programs are conducted timely manner with information is provided to them. Re-election is required. So at the AGM, they will be re-electing and rigorous annual evaluation form. So individually, we will be evaluating whether this director is doing his job reasonably well, right? With the performance indicators. Then the accountability part. The board should present a balanced and understandable assessment of the company's position, responsible for determining the nature and extent of the significant risk. Accountability. Maintain sound risk management and internal control systems. Whatever they do, they will be responsible for those decisions, individually and collectively. And also formal and transparent arrangements for considering how they should apply the corporate reporting structures. And the remuneration. All those will be leadership. So this will be covered a little bit more as we go. So there are multiple recommendations that have gone in, right? Leadership. Every company should be headed by an effective board, which is collectively responsible for the long-term success of the company. Specifically, effective board has to be there, collectively responsible for the long-term success of the company, not a short-term success story. If it is a short-term success story, they will make profits whatever the expense, right? So they want to make profits and fly the flag. No, it is sustainability that is important, like shareholders. There should be a clear division of responsibilities at the head of the company between the running of the board and the executive responsibility. This is where the chairman and the managing director have to be two different people. Our chairman is Mr. Nihal Jayawardena, President Council. Then our managing director is Mr. Jonathan Alas, right? Two individuals Mr. Jonathan Nallas is responsible for the management of the company. Mr. Nihal Javardhana is responsible for the managing of the board, full board. He's the chairman, right? No one individual should have unfettered powers. Everybody will have equal powers. All others, nobody is above anybody in the board. The chairman is responsible for leadership of the board. Chairman is responsible for the leadership of the board, not the leadership of the company. Okay, and ensuring its effectiveness on all aspects of his role. As part of their roles as members of the unitary board, non-executive directors should constructively challenge. If there is a non-executive director, a chartered accountant who has come there, non-executive, no executive role, he's an independent director. He has to continuously question the decision, challenge the decisions, right? Lot of things, right? We discussed a lot of things from 1990s in the UK environment, 2000 onwards in the US environment. Sarbanes-Oxley Act came in, combined code was launched, right? Multiple recommendations given by Turnbull report, Smith report, right? Cadbury report, Greenberry report, right? Higgs, all those have been incorporated into the corporate governance rules, right? Their reports are being published in the annual reports. They are being followed, all that, right? So has this stopped the collapse of companies, right? If I come from left side up, 2001 onwards, these are the corporate collapses, right? Computer Associates, MicroStrategy, Enron 2001, WorldCom 2002, Tyco International 2002, right? The list goes on, right? Implone Systems, then 2002, again, second column, bottom onwards, right? Homestone.com collapsed, Global Crossing collapsed, FediMac collapsed, right? All AOL, Adelphi, Nortel, 2003, AIG, insurance company, collapsed. 2009, up to 2009 collapsed. 2010 onwards, down here, Lehman Brothers, massive companies, Olympus, Bank Sadarat, Tesco, supermarket chain, collapsed. Toshiba, collapsed. Wells Fargo, 2017, collapsed. Wirecard. So multiple, 2020, up to 2020, I have listed here, corporate collapses continue. Right? How much we talk about corporate governance, corporate collapses continue, right? So maybe the speed has come down, but still, as we speak today, companies are failing. Especially, our Sri Lankan story is completely different, right? See how many places since the Easter bomb attack, COVID impact. See how many places are closed, how many businesses are closed. Banks are suffering because their customers are failing. SME sector is failing in a big way, right? Nobody is there to support them, right? Nobody is there to guide them. I don't know. So where are we heading on that line? Very sad. Collapses. Only thing is we are not coming in these boards because we are small companies, small country. We are not being listed anywhere. But there are multiple collapses in Sri Lanka. If you take just when you're traveling, you see how many places are there saying to let, to lease shop office environments or other shops. So we'll have a short break now before we move on to the rest of the presentation. Any question up to now? Any question? No questions? Right.
Seems no
We'll
question.
take no questions, right? Okay, we'll take 20 minutes break. We'll meet at now sharp 4:30. We'll meet at 4:50.
Okay,
Okay.
thank you.
Right. Thank you.